Hello guys, and welcome to our YouTube channel. Today we're going to be looking at how banks are participating on the forex market on our module 2 on currencies and banks. Now, looking at currencies and banks, as you enter into the currency world, the major question is how are currencies traded and who determine the price of these assets? Why are some currencies tradable when some are not? In this module, you understand key information on banking dynamics in a very simplified manner with examples you interact with on a daily basis. When it comes to the currency trading, it is just like any other business you know and have been exposed to. You buy a commodity in exchange for money. What retail shops do is that they want to buy the commodity at the cheapest price available with the intention of selling the commodity at the highest price available. You are not buying this commodity for personal use, thus you do not own this product but rather in stock for your business. This is the same dynamic that you find in forex trading, stock trading, cryptocurrency trading, or bond investing. You want to buy an asset that has potential to rise in price. In other words, the price is not fixed, so that you can profit on the price change. In the currency market, you find two types of regimes, that is free floating regimes and fixed regimes. As you understand how the currency market works, forex market is not a new business. It is as old as the origins of money. Each country has their own native currency and they need to trade with other countries on an international level has necessitated the conversion of one currency into the other. This is done through a broker or bank which will sell you the currency of the country you intend to trade with at the agreed intermarket rate. Some countries have fixed rates and their currencies are static. These types of currencies do not change much in their exchange rate. Other countries have free floating rates where they are exposed to market fluctuations of supply and demand of that country. Hence, the art of trading is to be able to identify currencies that have potential to appreciate in value. Then you buy them at a discount so that you can sell them later at a premium so that you can make profit on the price difference. You are able to buy or sell various assets through a brokerage house online-based trading platform. The broker offers you a range of assets and their quotes based on the intermarket rate. Your market orders are processed by the bank via a liquidity provider at the intermarket rate. Now, on your road map to profit. As in any business, profit making in currency trading is very simple. You want to buy at a discount and sell at a premium, and vice versa. For example, if you buy pound against US dollar, when 1 pound is equal to $50 US, and then you sell it at $2, you have made a profit of 50 cents. Now, the $1 million question is to know when to buy and when to sell. In this module, you understand how to frame a market context so as to know if an asset is in discount or is it in premium using technical and fundamental analysis. Technical analysis is the studying of the behavior of price patterns within a specific time frame. Fundamental analysis is the study of how politics, social, and economic values affect the intrinsic value, strength, and sentiment of an asset. Now, these are a list of tradable currency pairs that you can find on a variety of different brokerage firms. So, brokerages offer a variety of currency pairs ranging from 80 to 140 pairs. Some brokerages also offer commodities such as gold, oil, and silver. Stocks and currencies can all be traded on the same platform. Now let's look at the introduction to the basics of banking. It might strike you odd if you come face to face with this question: how do banks make money? Yes, indeed, the bank is more like the safety vault of our money. So the fundamental question is, how and why does it need to make money? Well, a basic fact that you cannot afford to forget is that banks are, after all, businesses, and they have a mirage of expenses and need funds to support all the staff that they need to hire for their effective functioning. It is therefore very important to understand how banks make money. The marketplace is full of various types of products and services. You have to understand that exactly in that way, the bank is like any business that buys and sells. However, their main product is money in various forms like loans, deposit, certificate of deposits, and many other types of financial products. A bank's fundamental business is borrowing and lending money. Their earnings comprise of the interest that they earn from independent customers. The interest at which they lend money is always higher than what they borrow money at. The difference in the interest rate is what comprises a chunk of the funds earned by both commercial and retail banks. They essentially borrow money from other customers who deposit their hard-earned cash in the bank for safekeeping. In that context, the rate of interest that a bank charges is entirely dependent on the demand and supply dynamics for a particular amount, the number of people who are ready to borrow the amount, and the exact amount that the bank can spare as a loan. Not just the bank's availability, but the loan's eligibility of every person who is dependent on certain norms specified by the country's central bank. This is because loaning money can be extremely a risky business, and there's never any certainty that the bank will actually get back the amount that is being loaned. Banks also charge customers a certain amount as charges or fees for taking care of the bank accounts of individual customers. There are a few other miscellaneous charges levied by the bank, like charges levied for overdraft facilities or check facilities and the likes. In the case of investment banks, there are some additional services like advising firms about their investment decisions, doing initial public offers or share issues that enable companies to list on the stock exchange, underwriting IPOs, and levying consultation charges on all of these. They also trade equities and have open forex and debt positions in the market to expand their wealth base. There are many other services that a bank caters to and levies charges on, like tailor fees, services, checking statements, account balances, accessing the bank account from any ATM which might not belong to the parent bank, and the likes. Apart from these, the loans that a bank processes also have a separate set of fee structures levied on all the various types of loans that are issued. So these are the fundraising tools for banks. Levying interest rate on loans. The bank levies varying degrees of interest rate on different types of loans depending on the duration of the loan and the amount of loan involved. Number 2, service charges. From processing fees to service charges to loan fees, it is an endless library of fees. When standalone, these are extremely nominal amounts. When accumulated, this becomes a significant large sum, increasing the bank's footfall. The customer base is any bank's backbone. Without the target number of customer base, proper functioning of a bank is absolutely impossible. That is why it becomes very important for a bank to nurture its customer base to make money. Then, number 4, interbank lending. Another very popular mode of earning money for a bank is through the rate of interest and via interbank lending. In simpler terms, it means that when one bank lends money to another bank, a certain amount of interest is levied on it. Auctioning of assets. Many times when an individual or a company defaults on a specific loan, the bank will impound the collateral that was given in exchange for the loan amount and puts it up for sale. These can involve a wide range of products ranging from houses, cars, and other personal belongings, including jewelry. Trading in securities. Many banks, especially the investment banks, are active traders in the equity, forex, and the commodity market. They have a huge customer base who are invested in the various financial instruments floated by them, like mutual funds, systematic investment plans, and the likes. The bank in turn uses this amount to invest in various securities trading as well as open position in the debt market as well. Charges for financial advice and services. Many big companies which are not listed thus far and plan an initial public offering seek the advice from established financial institutions like investment banks for effective execution of their red herring prospectus and eventual offering. Charges for votes. Many of us are scared to keep our precious jewelry, important documents at home. The threat of theft makes them nervous, and the bank comes to the aid of all such customers. They have vaults of various sizes and dimensions to suit the needs of many different types of customers who require these vault services. Apart from these, the bank charges many miscellaneous fees like charges for issuing a checkbook or ATM card or access the debit card, credit card transactions internationally. While the service charge for these specific ones are very nominal and the customer doesn't mind paying given the convenience it entails, the bank rakes in significant sum by sheer number power. As a result, banks make the business of making money a means of making money for themselves. Therefore, in summary, the purpose of this course is to equip you with the knowledge we believe will prepare you to make solid decisions as you enter into this level space. Future Gold Consortium has prepared a series of subjects and topics on financial markets and online trading that has a strong basic foundation for you to understand how to trade stocks, currencies, cryptocurrencies, and indices. If it's your first time, don't forget to subscribe and hit the notification bell so you'll be the first person to get new videos when we upload.